All right, Akshay Ramachandran. I'm really excited to have you on the show. Did I pronounce your name correct?
Yeah, man, you nailed it. Sounds exactly the way it's spelled.
Okay, perfect. So let's get started with you sharing who you are and what exactly are you doing?
Yeah, so my background is I worked in finance, kind of went down the traditional path of investment banking, and then I was at a family office for a couple of years doing everything from venture capital to private credit, private equity. But I spent most of my time on the public markets, looking at stocks, kind of global mandate, um, generalist in terms of industry, country, capital structure. Um, and so I did that for a few years. Was in the right place at the right time. Got lucky with a few investments, and I was kind of able to take a early semi-retirement. Kind of depending on how my investments perform. And so I've been traveling. I quit my job in March of 2021, and I've been traveling and living off of my investments since then. And I'm working on a couple of different projects now where I'm kind of trying to distill everything that I've learned over the last 10 years about investing and about analyzing business models for people that don't necessarily have access to the same kind of traditional banking, private equity, hedge fund path that I was really lucky to have access to.
So maybe we can go back to the beginning, where did you study and from where did you get this idea that I'd like to work for a family office and not just maybe for a consulting firm or a private equity firm?
I don't know how far back I should go, but I went to NYU for my undergrad. I studied finance and accounting, um, and kind of the traditional path is kind of laid out for you, right? In terms of when you get to one of these colleges to do, 1 to 2 years of investment banking, and then there's headhunters that kind of help you find a role in the private equity or hedge fund space. And I had kind of followed that path. And I actually didn't. I wasn't really familiar with family offices until my sophomore summer. I had done an internship at Archegos Capital Management, the family office that kind of blew up in spectacular fashion. I was there in 2015, and that was the first time I'd ever kind of heard of this concept of a family office where, um, they tend to be longer term in their thinking because it's permanent capital. They don't have to deal with LPs, and usually family offices are allocators, meaning they take a pool of capital and they give it to other money managers, whether it's private equity funds or other hedge funds. But there's been this rise of like the sophisticated family office that um, you know direct makes direct investments with its capital. And so I was kind of riding that wave to some extent. And I was going down the traditional path with headhunters, and a lot of these larger hedge funds, right? They're looking for um, a body more than a mind, right? They're looking for someone to like crank out a bunch of work. And that wasn't really what I was interested in. And I was willing to make the trade of like, okay, I'm willing to go to a place that is less known, that's smaller, where I'm not really chasing after pedigree, but what I'm really trying to optimize for is my day to day, my learning, finding a really good mentor in my boss. And so it's crazy. Like if you're willing to make that trade-off, like if you're willing to walk away from the pedigree, you get like all of these amazing qualities, right? Like if you're willing to go to a smaller place that most people have never heard of, and you're willing to take a little bit more risk, you're willing to be entrepreneurial, you can find like a lot of those other qualities, right? So for example, at the family office where I worked, I opened Bloomberg maybe like once a week. I remember there's the day that George Bush Sr. passed away, the stock market was closed. And someone had asked me, like, oh, did you see what happened to this, like, XYZ stock today? Or sorry, I asked someone else, like, hey, did you, like, what happened today to this stock? And they were like, dude, the market was closed today. Like, how do you not know that? Like, isn't this your entire job? It's like, no, that's not my job. My job is to like analyze companies. It's not to like look at a stock chart, right? And unfortunately, like most places on Wall Street, you're spending a lot of time creating deliverables, right? Like you're either in PowerPoint or you're in Excel doing a lot of work. Whereas my time was mostly spent reading and thinking, and very little time spent on PowerPoint and Excel. And the way that I was able to get that role was, again, like right place at the right time. A buddy of mine from Boston was visiting me, was not just visiting me, but like just visiting New York. And we were catching up over some drinks at a bar. Some of his other friends were there, and one of his other friends ended up becoming my future portfolio manager. And that was like, I remember that was the first interview where I was just super honest in terms of what I really wanted out of a job. Because when most people, like when I was interviewing previously, I was kind of trying to figure out what they wanted to hear, and kind of back solving for that, and crafting my message. But I remember when I first hopped on the phone, um, with my previous portfolio manager, I said, hey, look, like honestly, what I'm looking for is I don't want to spend that much time in Excel, and I definitely don't want to spend too much time in PowerPoint because I've already kind of done a lot of that, in banking. And what I really want to do is I want to find a place where I can tap dance to work in the morning. And for me, that would be just kind of reading and thinking, and analyzing like high quality businesses, great management teams, looking at investments over like a 5 to 10 year investment horizon. And it was just like it was like a perfect fit because that's like exactly what they were doing. But it required me to kind of take a leap of faith and kind of be like completely honest in terms of what I wanted, right? Like if I had gone to like Citadel and said that like same thing, that would have been like the shortest interview in history. Right? It would have been like a 1 minute interview. They'd be like, all right, that's not what we do. Get out.
So you mentioned like looking for a body more than a mind, obviously, and the same thing is that you were reading a lot, studying different businesses, but you don't need to get into the numbers. But how is the salary and commission? I mean, usually you have a fixed salary when you're working in this big investment firm. Uh, but how was it in your case? Because as you said, you were just studying and reading. Like, how many decisions did you make per month, per year? How many investments? And how was your salary and commissions?
Yeah, so in most of these roles, it's pretty standard. When you first start out, you get a base salary and a bonus, like a performance-based bonus. And then the performance is usually kind of subjective at the beginning, and then eventually turns into more a formulaic approach where you get some percentage of the profits generated by the fund that you work for, right? So the distinction is usually like junior analyst, senior analyst, and usually a senior analyst will get um, some percentage of the profits generated. So the family office that I work for, it wasn't like a huge family office. It was a really lean team. It was just me and the portfolio manager looking at public investments, and then there was one more person looking at private investments, um, and then the head of the family office. So very lean team. And then we had a handful of people that did, non-investment related stuff, just to keep the family office running, all the administrative stuff that, comes with making all these investments, right? In terms of the comp, I mean, it was like very generous. I was making like mid six figures in my early to mid 20s. It was like very lucrative. I mean, it was in New York, so um, yeah, it was I got like really lucky, and the hours were like 9 to 6. But it's not like I clock in and clock out, right? It's just like, hey, there's like this thing that we need to analyze, like go do it.
Mhm.
And then it was just a function of like how long it took me to go analyze the business, right? Yeah, so it's not like in banking, you're always on call, right? And it's about it's about selling an argument, right? So like there's just a lot of like work that has to be done in terms of like making the deliverables really like nice to look at, to make the information very digestible, versus in investing, you're just trying to find the truth, right? And so it's just a question of like how good you are at playing that game. And I had put in like so many hours before I even got to that role, because for me, investing wasn't just a career, it was an obsession. So kind of when I got started, like the first 6 months were a little bit rough, in terms of, getting to like the caliber of like analysis that, my portfolio manager was looking for. But, once I got there, then it was like kind of fairly like smooth sailing. In terms of how many decisions we made every month, I mean, I'd say we were looking at, um, anywhere from like 3 to 5 businesses like at all times. There's always gaps, right? Because we're not just reading like annual reports. There's also like meetings, and expert calls that need to be scheduled. And so I can't just schedule like it also depends on other people's availabilities, right? So then like based on that, I can stack like a few companies and I can look at multiple companies at once. But we would generally do like 1 to 2 months of research before, making an investment. That's generally kind of how it shook out in terms of what like how much time it took for us to get comfortable, because we were generalists, right? So we weren't like sector specialists. So it would take us a little bit longer to ramp up. But it allowed us the freedom to like make a wide range of investments in terms of country, in terms of industry, in terms of capital structure. So I think it was like an amazing learning experience.
And you mentioned like giving an overview of a specific deal to your boss. Could you maybe go through the what type of overview, what type of information you had to give? Like, I mean, opportunities, risk, like how long should this investment be, and what other criterias, or what type of overview did you give to your boss?
Yeah, so I mean, okay, so I'll give you an example, right, of how this process worked. So the way that the division of labor worked between me and my PM was that he would do like top of funnel, and then I would do middle of the funnel, and then we would kind of both do bottom of funnel, but he would do most of the bottom of funnel. So what am I referring to when I say the funnel, right? There's like hundreds of thousands, if not millions, of securities that we can invest in, right? So that's like the very, very top of the funnel. And that needs to get kind of whittled down into like the 8 to 12 stocks that, that we owned, right? Um, and if you include like all the private investment opportunities, the funnel is like even bigger, right? So he would run screeners and he would spend like 1 to 5 minutes on every name. And he was very good at whittling down like 1,000 names down to like 50 or 25. And then, I would go and look at like the 25 to 50 names, and then I would kind of bring that down to like 5 to 10, and then we would kind of discuss like, okay, which of these is worth spending more time on, right? And that initial math would look something along the lines of like, okay, is this a business? Not the math, but like the framework that we would use is like, okay, is this a business that we understand, right? If it's something like, you know, um, oil and gas, exploration and production, where the returns are mostly going to be driven on what oil prices do over the next few years, that's not really something that, we had any kind of expertise in, and there was just a very wide range of outcomes and something like that. So we would ignore that, right? So at the beginning, it's really the art of like saying no, right? Like finding like a quick reason to say no and to pass. And then once we have those 5 to 10 names, it's like thinking about like, okay, which one is the most attractive in terms of risk reward, right? Um, if we look, I don't know, I'm just giving you an example. Like if we found like a biotech name that if things like roughly work out, you do like the back of the envelope math in terms of like, what the addressable market is, what their potential penetration rate could be, what the margin could be, and then, what the valuation would be in like 5 years versus what it is today. If that comes out to like, okay, it can like double in 5 years, and then if it doesn't work, it could, zero like in a couple of years, right? So that's like kind of a wide range, right? Versus if we found another name, in that last kind of 5 to 10, where it was like, okay, the worst thing that could happen is like we're going to get like an S&P like return here, like, like an 8 to 10% annual return. And then there's kind of this like free call option in terms of like if this aspect of the business like ends up growing, we could end up getting like a 15 to 20% return, right? So we would like there would be multiple kind of ways to like really simplify what the risk reward spectrum could look like in each investment after spending just like half an hour to an hour on it. And then we would based on like which ones were most attractive, that's how we would prioritize which ones to spend the most time on. In terms of like what it would look like at the next stage, like when I would say, okay, this is like the name that these are the next like couple names I'm gonna look at. And then like when I go back and I'm sitting down with my portfolio manager, it would be something along, I'll give you like one kind of concrete example, right? So what had happened was we were looking at big tobacco, right? So like Philip Morris, British American Tobacco, um, and Altria. And the way that research process got started was there was like this 100-page equity research report by, I think it was Bernstein, that my PM had sent me over email, and he was just like, it was just one of those emails you just get. He just sends it, and he's like, thoughts question mark, and then I flipped through it, and I was like, wow, this is actually a really interesting story. So the story there was that a lot of funds cannot hold tobacco names for ESG reasons, right? So they're almost always like undervalued, right? At least like slightly undervalued because of that. And most people think of these big tobacco companies as evil cigarette companies, right? But what's actually happening is they're going through this transition where they're starting to introduce these reduced risk products like nicotine pouches, vaping, heat not burn tobacco. I know like, and also vaping gets like a lot of negativity in the press, but when you actually kind of look at the research, the data, it's like significantly less harmful than cigarettes. And like when you like as I was flipping through the report, they talked about how what really causes harm in cigarettes is the combustion, not the actual tobacco, and definitely not the nicotine, right? But that's still kind of like widely misunderstood, right? And then obviously tobacco companies are one of like the best business models in the history of capitalism, right? It costs very little to make. You can sell it for a lot. There's a lot of brand loyalty. They have this vast distribution network. There's all sorts of regulatory barriers to entry. You can't just introduce a new tobacco product in the US, right? Like it has to go through FDA approval, and tobacco companies aren't allowed to advertise in the US. So it's like the incumbents have like a huge advantage because of that. And all the tobacco companies in the US have to make these large fixed payments to the government from like a settlement that happened in the 90s. And so you kind of like take all these characteristics, like, okay, there's like some barriers to entry. This seems like a pretty good business. And there's like some kind of misunderstanding, misperception in the market. And then you kind of do the math in terms of like, okay, these things trade at like an X% yield, and some of that yield gets reinvested into the business, and then that's getting reinvested at like this incremental return, and then that equates to like a certain amount of growth, and then you add all that together, and you're like, okay, like we can get like a mid-teens or a high-teens return for a business that's like a relatively safe business model that I'm fairly certain is going to be around, in 10 years, right? And then you kind of go in, and then you create that hypothesis of, okay, there's high barriers to entry. There's like a growth story here in terms of the reduced risk products, and then we start to schedule like expert calls and start attending like trade shows and trying to do and start doing primary research to try and kill that hypothesis, right? And to the extent that we cannot kill the hypothesis, then it's a good then it might be a good investment, right? So one of the hypothesis points would be there's high barriers to entry, right? So we try to go find evidence that's not true, right? So what would we have to find in the research that would suggest that there aren't high barriers to entry, right? Like one example would be that the market shares like shift drastically, or another one might be there's a ton of of new entrants that come in. Another encounter, like another potential data point would be when we go to a gas station, there's like a ton of different options that a consumer can can choose from, and they're constantly like changing, right? And to the extent that we cannot find those things that would kill the hypothesis, then we have something interesting, right? So kind of like overlaying the scientific method of creating hypothesis and testing it onto our investment process.
Okay, and what about the other deals like you were doing? Again, you don't need to mention the names. Like how many deals did you do in this time 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 frame when you were working in a family office?
I mean, there's a big difference between the number of companies we looked at and the number of investments that we made, right? Like we looked at a lot of investments. I mean, over the 2.5 years I was there, we analyzed like over 60 industries together. Um, and we made, oh man, how many investments did we make? This is going to be tough because some of them like we bought, we were planning on holding long term, but then the multiple expanded by a lot, and then we had to sell, or something didn't work with the thesis and we sold. I don't know. Like if I had to guess, maybe we made like 15 investments when I was there, 15 to 20 investments, which is a lot because we were going through this period of transition um, from like the previous portfolio manager to the new one that had just taken over, a few months before I had joined. Um, but I would guess that there's not as much turnover in the book now. Um, so yeah, like on any given month, in terms of the top of funnel that my portfolio manager would look at, I mean, he's looking at like hundreds of names, right? And he has a lot more experience than me, so he's gotten very good at like very quickly saying no, like finding reasons to say no. So then in terms of like the middle of funnel, like the names were like, we did some expert calls. Yeah, I would say it would be like, 3 to 5 every month that we were willing to do the middle of funnel. But there's probably like 20 to 50, every month at the top of funnel that we're just constantly like looking at new names, right? Like we'll be like listening to an earnings call, and then um, there'll be like some kind of comment that one of the CEO makes that then sparks like an interest in looking at like a supplier or a customer or a competitor. And so we're constantly looking at like different things, or like a piece of news comes across, and then I quickly go look at the company's financials, and see if it's like interesting or not. But it's really the art of saying no is like the kind of the key skill to cultivate. But it's not just the art of saying no, but like correctly saying no, right? Because like errors of omission are deadly, right? Like even Buffett says his biggest mistakes are errors of omission, right? Not investing in companies like Google or Amazon.
You mentioned getting no's and saying no to opportunities. Let's talk about fundraising, because this is how you and I met. You reached out to me. You were happy to help with my deck. So I'd like to cover a bit about fundraising and your previous experience. What you see, what are the mistakes people are making when, for example, putting together an investment deck or approaching investors, and in general, and maybe specifically, you can share a few things which you saw on my deck and on my approach on this whole small journey of raising capital.
Yeah, I mean, in a way, I mean, like I think you and I have talked about this. In a way, it's like speaking a new language, right? Um, and when I say speaking a new language, I'm not referring to throwing out terms like EBITDA or due diligence or discounted cash flows. What I'm really referring to is like answering what I think are like the six fundamental questions of any like business or investment, right? Which is what problem is the business solving for customers? how does the business make money? Can it defend itself against competitors? How fast can the business grow for how long? And kind of what are the estimated annual returns and what's kind of the overall risk versus reward, right? And I think every investment deck or write up, whether it's a deck that a company makes or a write up that like an investor writes to, send to their portfolio manager or, to kind of just distill their thoughts on why they're making an investment, right? It doesn't matter if you're an entrepreneur or an investor, right? Like those 6 questions are still going to be the same, right? In terms of like, what are my estimated annual returns for a business owner? That's going to be like, hey, what are the opportunities for me to like reinvest back into the business? And what's the risk reward? And then for an investor, it'll be like, what are the investments that I can make will be kind of where the estimated annual returns question goes, right? But the fundamentals, like those other 5 questions, they're pretty much the same. And I think that needs to be answered in like a very clear, concise, and complete way, which, man, like very few companies do. And I'm talking like publicly traded, multi-billion-dollar companies, right? Because there's like one aspect to this where you want to just copy what other people do, right? So in the very, very beginning, right? When I got like the first draft of like what you had been working on, right? The key step in that first draft was just to kind of look at what other decks just generally look like and then just emulate that, right? Very simple. That's like the most straightforward part. The problem is I think people take that too far and just make the deck sound professional without really like saying anything like of value of like that really matters, right? Like an investor is trying to answer those questions as fast as possible, right? So when you look at most like investor decks, whether it's private companies or public companies, they're using like professional language instead of just saying what the business does, right? Like Buffett has this rule where when he writes his investor letters, he wants to write it in a language that his sisters that are smart but not that they don't have a background in finance or business that they can still understand, right? And like people study this in business schools. Like, like I had a class that was literally dedicated to this idea. And they use that example of Warren Buffett and that rule that he has with his sisters. And there's just like something that gets lost, between like what you learn in school and then you get to the real world, right? And it's just like I look at all these decks and it's like I can't understand what this business does, right? Because it's the language they're using is for people that have been following the company for many years, right? So one way of compensating for that is a lot of companies now do investor days, right? Where it's like, hey, from first principles, here's how our business, works, right? And so when I look at a deck, I mean, like, or when I'm talking to like investor relations, or when I'm talking to the company, whether it's public or private, I actually don't spend like that much time anymore really like thinking about, oh, like how do I ask different questions? Like I start off with like a very simple question, which is like, hey, like, can you just walk me through the economics of your business? And kind of like, are there any competitive advantages in your business, and like why do they exist? Why are they durable, right? And I think whether it's a CEO of a Fortune 500 company or an entrepreneur that's just now starting to build his or her business, they should be able to answer those 2 questions in like a very clear way. Like I'm lazy. Like I want the entrepreneurs to do all the work as an investor, right? Like I want to give entrepreneurs money, and I want the entrepreneurs to turn some like a little money into a lot of money, right? And so like if a business owner cannot describe how the economics of their business works and like walk me through the numbers in like a very simple, straightforward way, and they can't describe to me why they can earn kind of a high return on incremental capital that's put back into the business, and they can't walk me through what are all the reinvestment opportunities, that's just like I'm just going to pass on that, right? Because there's just so many opportunities where entrepreneurs and CEOs can do that, right? So that kind of ties back into that art of saying no. But I can give you some examples of companies that have really good investor decks. There's a company called Ashtead Group. The stock trades in the UK, but and they have it's an equipment rental company, right? So if like a construction company needs like um, like a big piece of equipment, like a bulldozer or something, um, Ashtead and United Rentals, they'll have a bunch of locations all over the country, and the construction company will make a phone call to the equipment rental company. They'll deliver the piece of equipment. They'll use it for a number of days, weeks, or months, and then the equipment rental company will kind of collect it back and repair it, and then do the same thing over and over again, right? Ashtead and United have some of the best investor decks I've ever seen. Like they very clearly describe how the business works, how the business makes money. They know what metrics to focus on. Um, and once you kind of get an idea of what that looks like, it becomes very easy to see like a deck and see like, okay, this is like missing a lot of stuff, right? And it's not just about making life easier for an investor, it's also a signaling thing, right? Like to me, when I look at investor deck, that to me that gives me a signal of how the management team thinks, right? And it doesn't have to be an investor deck. It can be an annual report, it could be a shareholder letter, or it could be an interview of the CEO or the CFO or the COO, right? Of the management team.
Yeah, you were saying like seeing the deck and seeing how they write about their business, you see how they think, obviously. So you can go from there.
Yeah, it's a huge signaling thing, right? Like if and I don't understand why like it's kind of been like a big frustration of mine. Like when you're in school, right, and you write an essay and you turn it in, right? Like the teacher kind of grades you on like your clarity and like the points that you're making and like the supporting evidence that you have. But when you get into the real world, there's no like that standard I think is lost a little bit, right? And when you join one of these big companies, they kind of it's tough with like internal controls in terms of what metrics get disclosed, and there's like this massive machinery of processes um, in terms of preparing like the financials and the presentations, where I think a lot of like what matters gets lost to the process, and it's like it's tough to kind of change what people have been doing for the last like 10, 15, 20 years. And so I think that there's just a lot of like bureaucracy and friction, I think that prevents this. But when I do see like clarity, it's like very obvious. It's like a 2x4 hitting me over the face.
Yeah, it's interesting because we were discussing this and speaking a new language. You speak in totally different language than I do when it comes to finance because you have this strong background. I'm pretty much been working all my life in sales. And from there, I got this idea of starting this holding company, which acquires those small niche manufacturing businesses which do 1 to 5 million in revenue. And when meeting and talking with those people, these are simple people. And the language you're talking at the moment, it's not their language. And what I want to say as well is I'm in this position at the moment where um, I've been sharing this as well. Like we had an investor. It's a simple old school guy who's been running a big business, hundreds of millions in revenue, old school guy. And I just sent him a short email, what I want to do. That, hi, my name is Mick. I'd like to start a holding company. This is what I've been doing. This is what we want to do. We want to acquire those small niche manufacturing businesses. And we see that 4 or 5 things how we can add value, and we target businesses which founders and owners are older than 50, because some of them they would just like to sell their business, and main reason often is that they don't have kids they may have kids, but the kids are not interested to keep running the business. And with
Yeah.
this one email, I think it was like, I don't know, 200, 300 words, maybe not even that. And this guy just got back to me like, yeah, Mick, let's catch up. And from there, we got this 5 to 7 million commitment, and same thing with another guy. And then we got a bit lazy in a way that, yes, we worked really hard to find the right deals. We eventually did. And then another opportunity came up for him, and he made the decision to invest all this capital back into this business. And now I'm pretty much back on day one, and we've been going back and forth, improving the tech with yourself as well. And the language I'm speaking there now, it's not me. It's too complicated. I don't know this type of words, this type of phrases. One thing probably is that English is not my first language. I know these words in my own language, but not in English. And now I'm in a position where I just need to learn a new language. Otherwise, it's probably really, really hard, if not impossible, to raise money from those extremely smart legends in the industry. But thinking about the future, this is the money I don't want to have, because during this 1 year period, we had some people who wanted to give us money as well, but we said no because I call them like they're too hardcore, and the future, it's going to be really hard working with them together, managing pretty much their money. It's going to be super, super hard.
Yeah.
Because the expectations, the reports, all those things, it's going to be really hard. I can't really focus on the business, improving their sales, improving their operations. I really need to think about how I'm going to grade the report for the next quarter, So speaking the new language, yes, it's important, but as you said, maybe it's just an excuse from my side, but I feel I'm more of this old school guy who, I know the numbers, I can read the balance sheet, but all the super complex things, it's not really my stuff, and obviously it's going to be harder for me to raise money because of that.
Yeah, so to be clear, the language that I'm talking about is okay, so let's like create some categories here, right? So one language would be like what most Fortune 500, American companies speak, when you listen to their earnings calls or you read their investor materials, right? And that's like very professional language. That's not really the language that I understand that language, but that's not really the language that I'm looking for when I'm looking at companies, right? And then there's like all the way on the other end of the extreme is language that's like simple and straightforward, but it doesn't tell me anything about those 6 questions that I'm trying to answer, right? What problem is the business solving? How does it make money? Can it defend itself against competition? Those questions. And then there's this middle ground where it's simple language that a 5th grader can understand, but it's answering those 6 questions, right? That's the sweet spot that I'm looking for. That's the sweet spot that I aim for, when I'm talking about investments and companies, and that's the language that I'm looking for when I'm talking to other people about them. Kind of the best way I think to learn that language is there's a website called Value Investors Club where a lot of them are professional investors, but it's where like anonymous investors post their ideas. It's like a higher caliber version of Seeking Alpha or Substack, but it's not a subscription. Like anyone can go view the ideas with a 45 to a 90-day delay. And they just describe the investment.
Is it from Joel Greenblatt or it's
Sorry?
this one?
Yeah, it's Joel Greenblatt. Yeah.
Okay. Yeah, and coming back to this investment decks, you mentioned like what matters gets lost and there's not enough clarity. You mean like all those sophisticated phrases and graphs and these things make it difficult for reader to understand, or from the design point of view, or you mean the simple clarity that you simply don't understand what exactly they're doing with their business and why do they need the money for?
Yeah, I think so. there's like this bare minimum level of like cleanliness in the design. Bare minimum level, it's like table stakes, right? Um, that was kind of like that first draft that I sent you where I used kind of that the PowerPoint template. Like I think after you kind of cross that threshold, there's significant like diminishing returns to spending time on like the design, at least in my opinion, right? Then I think all the benefit comes from like presenting accurate and complete information. Um, and so that can be done with literally just words on a slide, or like simple kind of graphs. Or I think the best way to do it is actually through write-ups. So I think it's Amazon, right, where Jeff Bezos doesn't allow PowerPoint presentations, where in meetings everyone is required at Amazon, as far as I understand, to write to actually like write out their thoughts, and then before every meeting everyone reads the write-up and then they discuss it. So I actually think write-ups are probably are the best way, in terms of, and I think they solve a problem for you, which you were saying that there's some of these investors are just too hardcore. They're looking for like all this like reporting and like it's not going to leave you any time to actually run the business. You're going to be on the phone with the investors all day. But if you do write-ups, there are like the world of investing is very big, right? Like there's all sorts of different flavors of investors out there. And I think if you do write-ups where you can very clearly explain in like, a few pages, um, the opportunity, or even when you're doing kind of like the regular reporting with your investors, like every quarter or every 6 months or every year, if you can distill everything into a simple write-up that's easy to follow, that's engaging, I actually think that's the best way to run the business, but also to attract the type of investors that you want. You want the investor that has the attention span and the willingness to read your write-up.
Mm-hmm.
But that does mean like when you first send out those emails or the write-ups, like within the first like paragraph, you gotta like give them exactly what they're looking for, which is some notion of like what kind of returns they might be able to earn. And this again goes into a little bit of like this signaling like dance. I think if if you go out and just say like, hey, I'm expecting like a 50% annual return, like no one believes that, right? Like everyone thinks that like they get like very sketchy, uh, a very sketchy vibe from that. But if you say something like, because there's this, there's this massive over um, supply of like small businesses in Estonia, but um, there's not enough buyers, which makes these businesses undervalued. And there's these double-digit top-line growing businesses that have thrived for many years, and they're available at you know 8 times, 10 times free cash flow. That's very attractive to an investor, right? And there you're just kind of stating like um, the facts, right? You're just saying like, hey, these businesses are literally available for 8 to 10 times free cash flow, and it's very reasonable to assume that they can grow their top line, their revenue in 10% plus per year, and that would be like something that would hook an investor versus doing all the math and saying, hey, I have a 50% IRR opportunity for you, because like now you sound like a scam artist. Like investors are biased like everyone else, right? It's like there's yeah, they want facts. They don't want like opinions. 8 to 10 times free cash flow, like you can actually like prove that out. You can say, hey, like here's like 10 companies we looked at that are available for that multiple. And there's a reason for why that exists, right? Because they're too small for private equity. They're these small niche manufacturing businesses. It's like it's it's a lot of work to go and find these deals, right? They're not just available, like they're not publicly traded, or even like there's no like brokers in this space that would create some kind of efficiency. So generally, like what investors are looking for is like a good return and an understanding of why that return exists, right? Because this is a pretty competitive game. There's a lot of smart people, a lot of hardworking people out there that are trying to generate good returns and trying to beat, the index or whatever benchmark they're trying to beat. So there has to be a reason for it. And there's this pattern recognition in terms of like reasons that have made good investments in the past. And so we kind of like try to pattern match that when we look at new ones.
Hmm. When we were discussing and you mentioning like buying a business for 8 to 10 times free cash flow, uh, you and I we were discussing about different businesses we would like to acquire, and many of them actually you said that the purchasing price is too expensive. I mean, there were some of them 6, 7, 8 times EBITDA, and you said it's probably way too much. And this is something we were discussing. Um, Now, my point here is that I'm probably not able to purchase them for cheaper. I mean, like 4 or 5 times EBITDA. And what should I do? Should I keep going and finding a better opportunity? Because finding an opportunity where I could buy a business for 3, 4 times EBITDA, it's not a good business with not too much potential. Whether this 6, 7, 8 times EBITDA business, I know exactly what we need to be doing. The current founder um, is interested continuing running the business. He just would like to sell half of it and keep building the business to 10, 15 million, where at the moment it's like 4.5. So what would you do in this situation where investors say it's too expensive, find something better, but I know deep down that I can't really find something for 3, 4 times EBITDA, which I'm able to grow and prove that we are actually good at what we do.
Yeah, I mean, we like public markets or private markets, kind of we face that dilemma every day, right? Like, do we want yield? Do we want the returns to come from yield or growth? Is this business even going to be around in 5 years, right? Um, I think like my initial comment in terms of like 5 to 7 times being a bit high for a small niche private business is okay. So here's the thinking that was kind of going through my mind, right? Like most small businesses fail, right?
Hmm.
Like the stats are like pretty overwhelming, right? Like the vast majority of small
But
businesses,
but
they don't
but in
survive
here,
for more than
but
5 years.
but in here, sorry for interrupting. We at the moment in our
No, no
case,
worries.
we are talking with businesses which have been around for more than 15 years.
Exactly, right? So the moment that you told me that, immediately my mind changed, right? Because when you had just mentioned the 5 to 7 times, I thought these were just like random small businesses. I didn't realize that they had a 15-year track record, right? So the moment you said, "Oh, these businesses have been around for 15 years, they've been thriving for 15 years," now I'm like, "Oh, okay." Now I kind of have a better idea of what kind of business we're talking about versus kind of just using that base rate of like the typical small business. You know what I mean?
Yeah,
So
so
like just saying that one thing of like it's been around for 15 years, it makes a huge difference, right? I remember we also had that like epiphany where you mentioned that you know like one of the businesses, they're getting a bunch of inbound requests from export markets and they haven't made any like outbound sales calls, right? That was like that was another spark for me that suggested that you're looking at something very interesting, right? It's always amazing when you get inbound requests from customers that you haven't marketed to in a market that's adjacent to yours, but not immediately in your market, right? So it's these little clues that you kind of pepper in that start to paint me kind of a more complete picture that suggests, hey, this business is going to be around for another 10 years, right? Because when you pay 5 to 7 times EBITDA, let's say that converts to like 10 times free cash flow, right? Depending on the capital intensity of the business, right? Like you pay 10 times free cash flow for a business. If it's a no growth business, right, it takes 10 years to get your capital back. The S&P 500, it looked very different like 20 years ago, right,
Mm-hmm.
versus today. The world looked very different even 10 years ago versus today. I mean, because of COVID, the world looked very different 3 years ago versus today, right? So I think there's this mistake that a lot of people, and I especially see it in the private side versus the public side, is people just like slap multiples on businesses based on like comps instead of like thinking bottoms up, like, is this company going to be around in 10 years and is it going to be bigger in 10 years than it is today? That's a really tough question to answer. That's not a straightforward question to answer, right? But these little clues of like it's been around for 15 years, they're getting inbound requests from customers in outbound markets. They have like all this low-hanging fruit in the business. Those are all little clues that
Mm-hmm.
start to kind of suggest to me, oh, okay, it might be at 10 times free cash flow today, but it's actually trading at 5 times 2026 free cash flow, right?
Should I
Then
sh-
like,
should I highlight that early in my presentation that okay, these are small businesses, revenue between 1 to 5 million. They've been around for 15 years and more. And interesting fact, there are many of them in our pipeline which they've never had a losing year. They've been always profitable. It was 2008, a
yeah,
tough year,
yeah,
2009. Few years ago was something going on, but they've been always profitable. Should I like
yeah,
how
that's, you're
aggressive?
speaking the language, man. That's it. Yeah,
Mhm,
that's the language. Like you literally
mhm,
just spoke it.
mhm, mhm,
You just hit like three very key points that any reasonably intelligent investor, if they see that, those are like
mhm,
gonna click off. Now, the thing is, you have to be able to prove that out, right? When you end up talking to them over the phone, because one thing is like you can say those things, um, and then once they actually start doing the research, if they start finding contradictions from like what you said earlier versus what they're discovering now during the research process, it's an immediate red flag. This entire industry is built on trust, whether
mhm,
it's business or investing, right? At the end of the day, a business is just a group of people solving problems for customers. That's it. Um, and as an investor, I'm not like investors don't get like all the information, right? They have to take a leap of faith at some point and trust that the management team, because like accounting, like you can make up the numbers, right? Um, so like the financial statements, even you have to take a little bit of a trust, which is why we have auditors and all those things, right?
mhm,
Um, and the reason, and we'll kind of sorry to kind of divert a little bit from what you were asking before, but one example I'll highlight is we were looking at this venture capital deal, and it was like a very the business model and the opportunity, the market opportunity that the business had in front of them, kind of checked a lot of the boxes that we have, right? It was like a huge addressable market. They were using technology and efficiency to take out a bunch of costs, and they were passing on those cost savings to customers through lower price. And then there's this really powerful feedback loop, like the kind of the classic Amazon, the flywheel that everyone's familiar with. But the red flag was that whenever we'd get on the phone with the CEO, he would say one thing on the phone call, and then when we would look at the actual like data, it would be different. And then he's making all sorts of adjustments when he's giving us the numbers on the phone call, and then those adjustments aren't being made in the deck. So now I have to like reconcile what he's saying versus like the actual data, and it's like it became like a huge mess. And that happened several times, and then we just lost complete trust and we just ended up passing on the investment opportunity, right? All those things you said are amazing, but you just have to be able to prove those out later on.
Could you give one or two examples of being an investor, knowing these companies exist? What type of proof you'd like to see, and what would you ask from me?
Yeah, I mean, something really simple. I mean, you said that these businesses have been around for 15 years. Like, okay, so then when I start looking at the company, I'm going to look at like what year it was started, right? Like,
Mm-hmm.
very simple to see that it's actually existed for 15 years. That might sound like silly, but you'd be shocked like the extent to which like entrepreneurs on the private side and management teams on the public side just like lie about like simple, straightforward things like that, you know, informally on a phone call, and then we go in, and then it's like, oh, no, this is actually different from what you said. In terms of they've never had a losing year, that's very easy to prove out, right? Like I just need all the historical financial information. um, in terms of like these companies have a lot of low-hanging fruit in terms of untapped export markets and product lines. Again, like when I'm doing the research, like um, I would just want to be able to see that very clearly, right? So I would look at like the revenue breakdown from customers and break that up into like what markets are they coming from, right? If you tell me that there's no export market, and then I look at the business, a week later, and it's like, half the revenue is coming from Estonia, and then half the revenue is coming from like Finland or something, immediately like I found a contradiction in what you've said, right? So my approach, my approach to this is a little bit different from other investors. I found that a lot of my friends, a lot of my peers, a lot of other investors that I follow, they use the framework of like they start from a place of like not trusting management teams, and you have to build that trust with them. I flip that on its head, where I start from a place of trust, and then during my research process, I'm looking for ways, um, for contradictions, to seeing if there's consistencies, and if that trust gets broken, then I'm more likely to pass. But I start from a place of trust because I've found that that's just generally been a better approach to just like relationships in
Mm-hmm.
general, but also in investing and in business.
How common it is that
But I don't make an investment before I do the actual research. I still need to do the actual research and test that trust.
how often have you seen that actually people lying about this stuff which we were just talking about? I mean, lying about the numbers, lying about when was the company started, lying about the fact that it actually hasn't been profitable always. Look at year 2011, 2013, they were losing like 200,000 a year. What's that? Like, how often have you seen in this industry, I would say, being an investor, meeting with companies, how often have you seen people lying?
Um, yeah, like the thing is, there's blatant lies and there's like kind of more nuanced lies, right? So I don't think I've seen a few, but not too many, just blatant lies. Um, because it's like what I'm looking for, in a management team is character and competence, right? Usually to blatantly lie about the year that like a company was founded or like how long the business has been around, you'd have to be like pretty low on the competence scale. Um, and I guess like I've been lucky that I haven't really come across those kinds of situations. But where it gets a little bit more nuanced is like, oh, they lost money in 2011 and 2012, but on a gap basis, but if you make all these adjustments for non-recurring items, then they were profitable. But then you go into the adjustments and it's like, no, these aren't non-recurring. These are like actual business expenses that, you shouldn't be adding back, right? These are actual like issues that are going to keep coming back. So that's like that aspect of making these adjustments and kind of making the numbers sing a different song. That I see all the time, all the time. I mean, I had one CEO of this. It was a roll up. Um, I don't know. I don't even know if I should say the industry, but yeah, let's just say publicly traded stock. Met with the CEO. Very like he'd worked at like impressive companies in the past. Kind of uh, like any person kind of sees his resume, you'd think like, oh, this is a smart, you know, like very like well accomplished guy. Um, and he said like, if I don't hit these numbers, I'm willing to go to jail. Like, and he like massively missed the numbers. Like we ultimately like there's some complexity in terms of like we initially didn't want to make the investment, but then we realized that like it wasn't actually the CEO that mattered. It was like the three guys that it was two of the guys, the COO and like the sales, the guy that ran the sales department that really mattered. So it was the CEO was just kind of like a glorified investor relations guy. And so then, we initially passed and then we kind of met the two guys that reported to him and then we really liked them. And then so we made like a small investment and then, uh, COVID had happened and, we kind of turned over our book and, went and like shifted from these kind of names that we weren't like that familiar with, the names that we had a lot of conviction in. So we ended up selling for that reason. And then like, here we are like a few years after that. And it's just a dumpster fire now. But the CEO literally said that. He said, I'm willing to go to jail if I don't hit these numbers. And like he completely missed the numbers. Because like one of the things from a psychological standpoint is like it takes a lot of confidence to get, to climb the ranks, in the world of business, particularly in the more traditional professional path of like you work for a company and then you rise, up in the corporate ladder. And even as an entrepreneur, like it takes a lot of confidence to, say like, hey, I don't like the way that this is being done, or hey, I see a gap in the marketplace. I'm going to go take advantage of that, right? But the thing is like the future is like inherently uncertain, right? So like confidence a lot of times, even from a capital allocation standpoint, whether that's a chief financial officer making capital allocation decisions or if it's an investor making capital allocation decisions, confidence is oftentimes like a really negative quality. Like you have to come to terms with the idea that like we live in like an uncertain world and there's like a range of like outcomes and you have to get used to like thinking probabilistically. So that's another kind of red flag when there's like way too much confidence that we see, especially when like the numbers don't support it.
Okay, man. Again, time really flies talking with you, and I'm sure you have tons of awesome stories from the industry. A few last questions before we wrap up. Where can people find you?
So right now I'm just on Twitter. My handle is 10x with Akshay, the number 10 letter X with Akshay, Akshay. I'm running an experiment right now to see if I can distill everything I've learned over the last 10 years into an online course. So then there's a link to that on my website. But yeah, that's kind of what I'm doing right now. I'm hoping to start a newsletter later this year, but I'm about to start a 3-month meditation retreat on July 5th. So I'll be off the grid for the summer, and then I'll be back in October.
That's awesome. So, famous five. I'll ask you a question, and you just give a short answer. How old are you?
28.
Favorite book?
Oh man, this is a tough one. Uh, like business book or just like overall?
Overall.
There's this book called Freedom Through Understanding. It was written by these two Buddhist monks, Lama Yeshe and Lama Zopa, that kind of talk about the fundamental tenets of Buddhism, um, and how to use the technique of Buddhism to subdue your own mind. And that's been the most impactful book I've read so far.
Okay, next one. Married, single, kids?
Single, no kids.
What car do you drive?
Oh, I don't own a car.
And what's the
I haven't
best?
owned a car in a long time.
Okay, okay. And what's the best investment advice you've ever got?
The best investment advice that I've ever got. I'd go with Peter Lynch, Know What You Own.
Perfect, man. Thanks a lot, and we can stop. We can stop here.
Sounds good, man. Thank you for having me.